The one bright spot in today's trading, big profits from two banking giants. JPMorgan and Wells Fargo both delivered better than expected quarterly earnings. At JPMorgan, profits surged 31% to $1.60 a share. That turned out to be 16 cents more than analyst estimates. Revenue also better than expected, up 14%. Wells Fargo posted a gain of 19% or 98 cents a share, a nickel higher than expected. Those gains came despite the recent jump in interest rates and the drop-off in lending in the mortgage market. But CEO Jamie Dimon said today his bank, JPMorgan, will continue to do well even as interest rates move higher.
When rates go up, all things being equal, it may knock down mortgage originations. Right. But if you have a healthy economy, that'll filter through all of our books of business. So all things being equal, rates going up is a good thing as long as the economy is growing.
Well, as for the outlook for the U.S. economy, Dimon is also pretty upbeat.
The American economy is slowly getting stronger, so the lending will come back when people have a little more confidence. They start to do more capital investing, and so we're kind of confident that you'll see growth over the years as America recovers.
And we'll learn more about the outlook for the banking sector next week. Citigroup reports its earnings on Monday, followed by Bank of America, Goldman Sachs, and Morgan Stanley.
And here to give us more analysis on those bank earnings from today and a look ahead to next week, Fred Cannon. He's director of the bank research firm Keefe, Bruyette and Woods. Frank, welcome. Good to have you with us.
Great to be on. Thanks.
All right, let's talk first about JPMorgan and Wells. What were the highlights and what were the lowlights in those reports? And there were more highlights than low.
There were. Fee revenues, number one, at both companies, stronger than expected, and also credit. Remember, these companies still have these big legacy asset portfolios from the financial crisis continuing to get better. And let's face it, credit's been tight the last 3 years, so there's been no problem credits developing. So as a result, they're releasing some reserves they made for those loans, and that's a key element to the growth.
So, Fred, do you think we're going to hear the same sort of storyline when Citi reports next week and also Bank of America?
We think so. I mean, remember, I think as Jamie Dimon said in your previous segment, this is actually getting to be a better environment for banking. Higher rates, while yes, there are some negatives, are a better thing because the spread between what you can earn on your lending versus your cost of deposits is widening overall when rates start to rise. The second thing is home prices. Home prices are drifting up in the U.S., and the recent run-up in interest rates isn't dampening that. So both of those things are a good thing, good backdrop for second quarter earnings.
You know, we've seen an awful lot of strong performance from the mid-size and the regional banks. What are they doing so well? I'm not talking here about the big ones, though that's sort of our main focus tonight. What are the mid-size guys doing well?
Lending. If you look at the data for the second quarter, the large banks' lending increase was a little over 1%. Not great. The small banks overall was about 8%. So really the small banks are the ones out there aggressively getting out there with customers and making those loans. That's what they're doing right, and that's why some of the stock prices are doing quite well.
You know, when we look at the Keefe Bruyette Bank Index, it's been pretty much on the rise since the beginning of the year. Do you see that continuing, and are there any stocks, big or small, in the banking sector that you're recommending?
We do think it's a pretty good environment. Interestingly, the valuations to a lot of my analysts in my group are kind of stretched, so they're getting nervous at this point in time. We were up 25% year to date, and after a good run last year. But remember that Keefe Bank Index is still 40% below its peak pre-cycle. A lot of that has to do with dilution, but a lot of it has to do with this low interest rate environment keeping earnings down. Well, as interest rates start to rise, if home prices continue up, it's a pretty good environment. We think Citi's still a great investment. We think it's a great restructuring story and should do well in this environment. A little nervous about those emerging market issues, but we think it'll do fine. And on the regional side, there's a number of regional banks. We actually think you should look upstate New York right now. If you look up to Buffalo, there's a couple of banks we're pretty big on right now. First, Niagara, they've had a little bit of tough time, starting to turn around, and same with M&T Bancorp.
Let's talk a little bit about something you just mentioned a moment ago. It's a good lending environment for banks because they're able to command more on their loan rates, and their cost of securing deposits is relatively low. Another way of saying that is they've raised their loan rates, but they haven't raised their deposit rates. Do you expect them to raise their deposit rates anytime soon?
No, the banks are swimming in liquidity thanks to Ben Bernanke and the Fed. So we think that there's going to be plenty of deposits around for a long period of time. So if you're one of those savers out there, don't expect CDs to go up anytime soon.
That's what I'm asking. Fred Cannon, thanks very much, Director of Research at Keefe, Bruyette and Woods.
Great to be on. Thanks.